HDFC Bank, the largest and the most profitable private sector bank, has been seen as the most consistent performer on the street for many years now. It has delivered manifold returns since its listing in 1995. It has generated compounded annual returns of around 19% in the last 20 years, significantly outperforming the NIFTY. However, the HDFC Bank stock has corrected almost 30% from its 52-week highs or all-time highs prices following the outbreak of Covid-19. In our Ideas for Profit today, I'm going to be discussing if the Covid-19 scare and the subsequent containment measure of locking down the entire country mark an end to the stock's more than 25-year-old bull run. Well, firstly, bull runs in stocks get affected if the earnings start to falter. It is worth noting that while the private lenders' earnings will be materially impacted in the near term, say next couple of quarters, Covid-19 outbreak does not permanently impair HDFC Bank's long-term earnings potential. However, investors should consider buying HDFC Bank despite the significant headwinds and its earnings in the near term as well. HDFC Bank has ability to actually maintain competitive advantage over the competitors in order to protect its long-term profits and also the market share from competing firms. It enjoys a strong funding profile, almost a stress-free asset book unlike competitors, better distribution reach in interiors of India, and solid technology prowess. HDFC Bank has also succeeded in cracking the code to borrow cheap and underwrite well. The bank has posted robust profits through with the compounded annual growth rate or CAGR of over 30% for the past 20 years. HDFC Bank's loan growth of 20% and deposit growth of 25% as at the end of December 2019 stood way above the industry loan growth. So what is driving the bank's growth? HDFC Bank has identified multiple growth engines like wholesale, MSME and digital offerings for boosting its loan book in the days ahead. HDFC Bank is well utilizing the opportunity in the corporate lending by gaining market share from public sector banks that are saddled with non-performing assets or NPAs. So does the high unsecured book pose asset quality risk for the bank? And how will Covid-19 scare impact the bank? Well, the bank's unsecured lending is mainly to its existing customers, 70% of them, and which is very comforting. Also, a significant portion of this portfolio is towards the salaried employees of top-notch companies where job losses are less likely. That said, HDFC Bank cannot remain unscathed from the pandemic. Covid-19 related social distancing measures can lead to moderation in loan growth, lower margins, slower growth in fee income, and higher NPAs. FY 2021 earnings will be adversely impacted and the extent will depend on the duration of the pandemic and regulatory response. For instance, a rapid rate cut by RBI can result in treasury gains and help partially offset the negative impact of the pandemic. HDFC Bank's valuation has fallen to multi-year lows, while the long-term growth and profitability outlook is still very strong. At the current market price of 900 rupees, HDFC Bank is trading at 2.3 times the core book value estimated for FY22. HDFC Bank is also the most buy stock and should form a part of every investor's core portfolio right now.